Imagine you wake up one morning, you grab your phone and check how the markets are doing. Gold is down again, silver down even more. You scroll for a second, charts, red candles, panic posts. Someone messages you. I thought gold was supposed to protect us. And you don't really know what to say because it's not just metals. Stocks are falling, cryptos are selling off. Even bonds, which are supposed to be safe, are under pressure. Everything suddenly feels unstable. And if you've been following the gold and silver story, it might feel like the narrative has completely changed. Just a few months ago, people were talking about shortages, revaluation, a major long-term bull market. Now, the conversation is different. Now people are asking, is it over? Today, I want to walk through what is actually happening because while prices have clearly moved in the wrong direction, the deeper story hasn't really changed at all, in my opinion. By the way, I'm Noel Lorenzana, and over the years, I've learned that when markets feel the most confusing, it's best to step back and reevaluate the fundamentals. And if you like this type of content, please be sure to like and subscribe. What just happened? Let's start with the facts. Gold has pulled back significantly from its highs earlier this year. We saw prices approaching the $5,500 level, and now we're trading closer to $4,500. Silver has been even more volatile. After pushing toward the $120 range earlier in the year, it's now fallen to under $70 an ounce. Those aren't insignificant moves. Moves like that shake investor confidence. They make people question everything. But here's the important part. This hasn't happened in isolation. The stock market is in correction territory and has given back their gains for the year and then some. Cryptocurrencies have sold off. Even bonds, which investors typically run to during times of uncertainty, are struggling. At the same time, oil prices have been volatile, rising sharply one minute and dropping the next. Obviously, as tensions surrounding Iran continue to escalate. And perhaps most importantly, the US dollar has been strengthening. This isn't just a precious metal story. It's a broader market environment where liquidity is tightening, appetite for risk is fading, and investors around the world are repositioning. And when that happens, almost everything can get sold off, even assets that people believe are long-term safe havens. The real story behind the pullback. So what is actually driving this pullback? In my view, this is much less about gold and silver and much more about the global financial environment tightening very quickly. You see, when geopolitical tensions rise, especially involving major energy regions like the Middle East, markets don't always react the way people expect. Many investors assume that war automatically sends gold and silver straight up. Sometimes that happens, but often the first reaction is very different. I cover that in my video right up here, but basically, oil prices start to rise, inflation concerns start to reappear, central banks become more cautious about cutting rates, and suddenly the US dollar begins to strengthen, albeit temporarily. Now, why does that matter? Because the dollar is still the world's primary funding currency. When stress builds in the system, institutions, governments, and investors often move toward dollar liquidity. They raise cash, they reduce leverage, they sell positions. That process can create broad selling pressure across markets. Sometimes safe havens fall, not because they failed, but because someone, somewhere, suddenly needed cash. So when gold and silver decline during periods like this, it doesn't automatically mean the long-term story has changed. It may simply mean liquidity is being repriced and markets are adjusting to new short-term risks. I know that's uncomfortable, but volatility like this is normal of major bull markets throughout history. What I believe we're seeing is institutions temporarily reducing risk across the board, from euphoria to doubt. Another thing that's important to understand is how quickly market psychology can change. Earlier this year, the mood around gold and especially silver was extremely optimistic. There was lots of talk about physical shortages and strong demand. Some people were even talking about once-in-a-generation moves. Prices were rising quickly, momentum was strong, social media was blowing up with excitement. And when markets move like that, it's very easy for confidence to turn into certainty. But markets don't move in straight lines, and when a sharp pullback happens, especially one this large, that certainly can flip the script overnight. Now, instead of asking how high metals can go, people start asking whether the entire bull market was a big pump and dump. Some investors see opportunity, others see the start of something worse. And many who bought near the highs now feel trapped. But this kind of volatility has shown up again and again in major bull markets. Sharp advances followed by sharp pullbacks, momentum followed by doubt. And in the middle of it, it often feels like something fundamental has changed, even when it hasn't. What has actually changed? So after all this volatility, after the sharp pullbacks, after the sudden change in sentiment, we have to step back and ask a very simple question. What has actually changed? Because if you look beyond the daily price movements, many of the structural forces that push gold and silver higher in the first place are still very much present. Governments around the world are still running large fiscal deficits. Debt levels are still rising. Interest payments alone are becoming a major part of national budgets. Central banks around the world are still accumulating gold at historically high levels. That trend hasn't stopped. If anything, geopolitical tensions may reinforce the desire to hold real reserves rather than financial promises. And when it comes to silver, the long-term supply picture hasn't suddenly improved just because prices corrected. Industrial demand remains strong. Above-ground stocks are still relatively tight, and the market has been operating in a structural deficit for years. It's quite possible gold and silver trade sideways for a while. A correction doesn't automatically mean the original thesis was wrong. Sometimes it simply means the market moved too far, too fast, and now it needs time to reset. We've seen this movie before. If you've followed financial markets for a while now, none of this should feel unfamiliar. There have been times in the past where gold and silver experienced sharp declines, mainly because the broader financial system was under stress. One of the clearest examples was during the financial crisis in 2008. In the early stages of that crisis, gold fell. Silver didn't just correct, it was just about cut in half. Investors were facing margin calls, funds were being forced to reduce exposure, and liquidity suddenly became very important. And in that kind of environment, almost everything gets sold off. Didn't matter whether an asset was considered a safe haven or whether long-term supply outlook suggested higher prices. What mattered in that moment was access to cash. But what happened next is what people often forget. After the initial wave of forced selling paused, both gold and silver went on to experience powerful bull markets in the years that followed. Sharp corrections didn't end the story. They were part of it. During pullbacks, perspective matters. So what should investors take away from a pullback like this? First off, real hard assets can be extremely volatile. You need to understand that. They don't move in straight lines. They can surge higher and then correct just as quickly. That doesn't mean they're broken. Periods like this also tend to expose leverage. When liquidity tightens and volatility rises, positions that once felt comfortable can suddenly become difficult to hold. This is why experienced investors emphasize patience. Now, to be fair, some investors believe the highs earlier this year may have marked a major top. They point to rising yields, a stronger dollar, and the possibility that global growth slows more than expected. And these risks are worth watching. But in my view, they don't negate the longer-term structural forces that many investors continue to focus on. Short-term noise versus long-term reality. So yes, gold and silver have pulled back, and yes, the moves have been uncomfortable, but this is not the same as a broken thesis. Markets react constantly to war developments, to energy prices, to interest rate expectations, to shifts in geopolitical risk. Those forces can drive prices in the short term, but the deeper structural trends, rising debt levels, ongoing economic pressures, geopolitical problems, and the ongoing search for real stores of value, they tend to unfold over much longer time horizons. That doesn't mean volatility is over, and it doesn't mean metals will move in straight lines from here. But sometimes what feels like a major turning point is simply the market adjusting to a new phase of a longer cycle. Agree, disagree, let me know what you think in the comments below. By the way, I'm not a financial advisor and none of this is investment advice. And if you want to know if the war against Iran will wreck your savings, then you need to check out my other video right up here. Thanks for watching and see you in the next video.